Okay, so we have asked you to give us some insights into stats, processes, things that are applicable to property investors.
Yeah, look, I love my data, Rob. So, every year I wait with anticipation for the stats to come out. So, let's talk to the latest 2021-22 stats. And what were the headline numbers that came out of that, out of those results, Rob?
Yeah, sure, Ben. So let's talk about the stats for rental properties, maybe. Um,
Yeah, sounds great.
so I've got them up in front of me, so I make sure I get the right figures because there is a number of stats, right? But so we got 2.2 million rental properties were reported to us. 2.3 million people reported on the income tax return having rental income or deductions, and 71% of those owned one property. So that's either individually or jointly. There's $50.4 billion of income that was reported and 44 billion or more than $44.4 billion in deductions that were claimed. And so in 21-22, this showed that about 58% of properties were positively geared. Now that's 21-22. That fluctuates a little bit depending on the interest rate, but that was positively geared to a rate of about $6 billion. Interestingly, 87% of landlords reported or lodged through a tax agent. So, property investment and the tax consequences can be quite tricky. So a lot of people, do seek the help of a tax agent. And also 75% of individuals reported on the income tax schedule a deduction for a rental property manager or rental property expense. So, they're probably the headline figures.
Yeah, interesting stuff, Ben. Hey, there's a couple of things there that I think are interesting, Ben, is 58% of properties are positively geared to the rate of $6 billion. So clearly, as interest rates start to grow, that'll fluctuate. But that's an interesting step for you and I to ponder, given that a lot of the narrative is around the majority are getting needed gearing benefits.
I think it's important to understand. I mean, I think there's this perception that everyone just gets into investment property for a big capital gain, and they're happy to sort of run the property loss for a future gain. But obviously, a lot of what we talk about here is, building wealth and building passive income off the back of that is demonstrated in the data here when the cost base is lower. So that is a product of obviously record low interest rates. And so that's yielded obviously a positive income return for government, which they'll charge taxes against. But from the investor's point of view, it's really important to understand that building that passive income is just as important as that future gain, and that's why we're strong advocates of a couple of really good investment properties supplemented with your superannuation is a really sensible way of building financial security, and that's sort of showing up in that data that with 58% of those holding those properties for the longer term. There'll always be some type of expenses, coming back to the point around 75% of individuals recorded a claim of a deduction. So if you do run a property manager, or if you've obviously got some expenses associated with that property. So I think that's fair and reasonable in terms of, in fact, I thought probably it could have been a little bit higher if there were some further deductions. That seems like maybe someone didn't have their supporting evidence. So it's really interesting. And it probably is a good question in terms of why, Rob, why do we obtain these sort of numbers, and why are they important in terms of sharing those statistics to the general public?
Ben and Bryce, so I think with respect to all our statistics, it's just about an element around transparency. So obviously we have reporting requirements across the ATO, but we also do want to make sure that there's transparency in the data across all the statistics that we provide to the community. As I said, the most recent ones are 21-22, but that's part of the reason that we
And so how do
provide
you
it.
obtain that sort of data, and why is there a lag in the data, Rob?
Yeah, good question, Ben. So we have to wait for the year to be over. Obviously, can't do it mid game. I think we've all seen footy games where mid game it's looking one way, and then by the end it's something completely different. So we definitely have to wait to the end of the year. Obviously, then as I said, if you talk about rental property data, 87% of the property investors use a tax agent. Tax agents have an extended lodgement program. That means they essentially can lodge through till the following year.
Yep.
So that causes a lag. And then it's not until we have that and we have all the information statistics, and we obviously go through a QA and publishing process around that data to make sure we've got a level of confidence in it, that it's kind of ready. And so that's what causes the lag. And you can find a lot of information at atu.gov.au/tax stats, which has all the tax stats, the most recent tax stats that we have available.
Yeah, because we get that a bit, don't we, Ben? Where we are quoting, particularly when we do presentations, we do like to use source quotes from the ATO, right? So there's always been a lag when we've done that. So it kind of makes sense that there's no point reporting stats that aren't complete. So therefore, you will only ever get a couple of years ago stats to reflect where we're at. And there's a bunch of extrapolation that you can do from that anyway.